As the world shifts to clean energy and investors move away from fossil fuels, there's a glaring irony to the whole situation. Those dirty fossil fuels have become golden.
If you look across the commodity suite, we have coal up over 400% from lows last year, oil's up over 500% from last year. We've seen LNG peak at over 2,500% increases on lows of last year. This is an unprecedented phenomenon.
A cargo ship filled with LNG gas leaving Australia this week is worth about $280 million. Last year, it was worth just $10 million. Get that. Last year, 10 million. Right now, 280 million. Oil is back above $80 a barrel for the first time since 2014, and coal prices are at record highs.
The sustained level of price gains we're seeing at the moment is really once in a lifetime situation.
Prices are skyrocketing thanks to the simple rule of supply and demand. Demand is rising as the Northern Hemisphere heads into a cold winter, but supply of fossil fuels is falling due to investors abandoning the space.
I think we do also need to recognise that part of what's caused the issues here is a reduction in redundancy across the commodity suite, as investors have shunned increased investment in oil, gas and fossil fuels, and therefore the buffer isn't there when you need it in key demand centres when you have a cold winter like this.
The COP26 climate conference will be held in Glasgow at the end of this month, and the Morrison government is under pressure from its global peers to commit to a net zero emissions target by 2050.
The renewable energy sector is growing quite strongly, but it's not enough to meet demand, and we're not seeing the fossil fuels really fill that gap at the moment. So this is the consequence of this transition to renewable energy.
Take China as an example. To bring down emissions, it ordered its coal-fired power stations to reduce capacity. But there have been power blackouts across the country, plus coal shortages at its mines. So capacity has had to be ramped back up again to keep the lights on.
But ultimately, this still has provided a shock to the market and a wake-up call that fossil fuels still have a life left of them, regardless of net zero 2050 or earlier. And the crucial role that they play is factoring through now to jobs, to economies and to politics heading into COP26.
China also banned Australian coal imports this year, effectively paying more for coal from other countries. This tripled the price of coal. But due to the electricity outages, China has had to do the unthinkable, lifting the ban on Aussie coal to deal with the shortage.
They're consuming about 4 billion tonnes of coal, but only importing around 100-odd million tonnes. What happens in China, particularly around domestic output, is going to still reverberate through the international market, which we're seeing at the moment.
The Treasurer says surging prices for LNG and coal will benefit the economy, which has been dealing with a sharp fall in the price of iron ore since July.
The iron ore price does fluctuate, of course, and we've seen highs this year of above $200 a tonne, then below $100 a tonne. But we had it in the budget at a pretty conservative estimate, or forecasted around $55 a tonne. So when it's above that rate, which it is today, that is of benefit to the budget bottom line. With respect to gas, with respect to coal, there's still strong demand, both metallurgical coal and thermal coal, as well as gas. And of course, we're seeing some of the price pressures across Europe right now.
The thermal coal price has been rising all year, and this week hit $244 a tonne. And Whitehaven Coal has done very well, with its shares gaining 104% over the last 12 months. It now expects to be debt-free within 6 months.
Iron ore brings in about $100 billion a year. Coal and gas is around $30 billion, and that was based off prices under $100 a tonne for thermal coal, for example. So if you saw the doubling or tripling that we're experiencing at the moment, persist for at least another sort of 12 months, then you can see the magnitude of change we would see in terms of export revenues.
Aussie oil and gas companies are benefiting too, especially gas giant Woodside Petroleum, which was forced to write down its assets by $6.3 billion last year due to weak prices.
Well, in Australia, the oil and gas suite has had a great rally over the last 3 or 4 weeks, but that's after being terribly beaten up over the last 24 months. We see the greatest exposure is those with greatest LNG and gas exposure, which is Woodside and to a lesser extent Beach. But we think, the rising tide is going to raise all boats here, and we've already started to see that play out.
The question now on investors' minds is when these energy prices will start to trickle through to inflation and potentially to higher interest rates.